Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us the volatility is like the inflation-charged markets back in the 1970s. He takes a look at nickel, commodities, and crude. We dig deep into gold and silver with Ed Steer, founder of EdSteerGoldandSilver.com. He says the precious metals market was closer to disaster than many would have suspected. Publisher of WolfStreet.com, Wolf Richter checks in from San Francisco to talk about inflation, cryptos, nickel, real estate, and the new and used car markets. Plus, at the end of the show, we'll have a company showcase update from Zarko Meseldzija from American Manganese. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to This Week in Money.
Good to be back with you, Jim. And it's always, as we've been having recently, it's New Rules Week.
New rules? What is it, like Aussie rules football, no rules?
Yeah, I mean, what happened? The price of nickel used to be something you could pretty much count on. Now, what do?
If you naked short, $8 billion worth on the London Metals Exchange, interesting things can happen.
Yeah, the thing with banks, though, if you owe the bank $1,000, that's your problem. If you owe the bank $8 billion, that's the bank's problem. So look at this. The price of nickel goes to $5,600, squeezes the hell out of everybody. The exchanges do as they love to do in times like this, and we've seen it with silver, we've seen it with potatoes, we've seen it elsewhere. The exchange does what it has to do to protect its members and the banks behind it. So they halt trading, they reinstitute with new rules, and now the price is down to $2,800, and who knows where it ends up. But I'll tell you, the big boys, they're out for one person, and that's themselves, and that's what's going on right now. Then, aside from what went on in the nickel market, we have had some extraordinary price action, basically dating back similar to what we saw in the days as far as the commodities are concerned, back in the 1972 to 1974 run, back in the anchovy problems out of the South Pacific, and the run that caused in soybeans and other commodities. And well, this time, if you've got planting season coming up in Ukraine and you don't have that nice 30 to 60 day window sitting out there that's going to be available to you, we're going to have a real problem with grain prices. And that was very, very evident this last week. We saw the wheat market just go up and create some big exhaustion signals, very similar to what we saw in the mid-1970s. We're pretty much tracking what I like to look at, which is the extremes in markets. Forget about the news events that are driving them. I mean, each time around it's going to be different. The story will alter. But the key to me is recognizing those inflection points where the holders of positions are panicking because they're getting the margin calls and they can't afford it, and the other group that's sitting out there want to take advantage of this run, and they are paying up and paying exorbitant amounts only to see themselves have reversals. So this it makes for some pretty big opportunities. Tuesday of this week, We had upside exhaustion readings on the precious metals, gold, silver, palladium. You also had it in the base metals unexpectedly. The mining stocks, the GDX, up into exhaustion mode. So correction is starting to take place the second half of the week. It's pretty much as it should be at this point. So a first big shakeout, and then I think we've got to go back and retest the highs. And depending upon how deep this first pullback is and how long it takes, and that could be the better part of it, a month or two, the consolidation we'll be looking at for a couple of trading opportunities. First one is a buy on the dip, and then we'll see how the bounce occurs after that.
Oil, is it still continuing its march higher?
Oil, just classic here. The 10-year cycle, which had that delay because of COVID coming off the bottom, was scheduled to top out in February through April, May. When we punched through the resistance here a week and a half ago, the measured target, and when we take a look at the base that it had been in, and we look at the previous high back in 2008 up at the 145 level, the projected resistance lines from there were at 132 to 138. And this week, right into the top, high trade was just a shade over $130. Pretty good pullback right at the tail end Thursday, Friday. And this continues, as far as we're concerned, to be, from a technical perspective, in an uptrend. There's a key support at the 21-day moving average, which we came within $1 of on the pullback at the tail end of the week. And that needs to hold. What we're looking for is that continuation, as I say, probably kiss and go from that. But the next high that we end up seeing in the oil market, we're going to be watching pretty close on things like the relative strength index and the stochastics to see if there's some bearish divergences up there. And that could give us a much deeper correction. I'm thinking eventually we could correct half of the move that we've had in the last couple of months. So could be a big-time move, and who knows what the fundamental background might be to that, but we'll just watch for things as they evolve.
How's gold doing with all this turmoil?
With the turmoil, you got just a great move like you'd expect to see. We had absolutely extraordinary volume in the spot silver and gold prices, or in the not in the prices, but in the volumes. And depending upon which items you're looking at, it was anywhere from 2 to 3 times record numbers that I can see going back. So you've brought upside exhaustion signals, as you would expect with that to the extent of the run. Just the perfect spot for gold to have a little bit of trouble in here. We've got this big cup and handle saucer base that's been going on since the better part of 2011, and then you've got a minor base that has happened within the last year and a half. The first measurements out of that were actually achieved at 2070 this week. The next series of numbers, and I'm assuming that we end up finding support on a pullback around the February highs, but the next levels of support are going to be up around over 2,200 for the next target here. But it's going to take a while of consolidation before we're ready to have that kind of a run. Still, with the record volumes that we saw, both gold and silver, that would imply that the public is back in a pretty big way, and we do need to see a fair amount of chattering around here before things can be ready for that next big run.
And we'll be talking with our gold and silver expert, Ed Steer, in just a minute. So perfect timing, Ross.
Oh, good. I'll look forward to that.
Ross, thank you so much for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can also find him on Twitter at Charts by Ross. Coming up, Ed Steer, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Ed Steer, founder of EdSteerGoldandSilver.com. He's speaking to us from Merritt, British Columbia. Welcome back to This Week in Money.
Yeah, well, good afternoon to you, Jim, and all your listeners as well.
Ed, we've seen a record volume in gold and silver trades. So, of course, we know what's caused the excitement, but where do you think we go from here?
Well, you know, certainly the price should be screaming higher. You know, we got over, I think it was we got to a new record high price, and the price was capped and turned lower. Now we're sitting back just below $2,000 an ounce. The big, you know, they're obviously still shorting the market and keeping the price in check, but, you know, the price should be, you know, way, way higher than this. And of course, as you know, prices of every other commodity, whether it be nickel, which is a case in point, and a bunch of other commodities are screaming higher, like wheat and a bunch of the grains. So, you know, gold is destined to follow at some point, and one of these days it's going to make a really big move of some type. So that's what we're all waiting for.
Mm-hmm. What does gold tend to do in times of inflation and war?
Well, just like every time we have that sort of thing, that's exactly, they should be rising, and that's exactly what they're doing, and that will continue until it doesn't. As far as I'm concerned, we've got a long way to go as far as the gold price is concerned, and we're going to be hitting new highs certainly as the year progresses.
Now, the London Metal Exchange froze trade in nickel because a Chinese tycoon decided to naked short something like $68 billion worth of nickel. Do you have any fears or concerns that the same thing could happen on the exchanges with gold and silver?
Okay, well, this all happened in the LME in London, and of course, we're talking about the short positions in the COMEX futures market, which is which is a totally different exchange. Right now, there are no limits on how high silver and gold prices can go. And the question as to whether the exchange will step in if prices do blow sky high is a very legitimate one. You know, silver analyst Ted Butler, who, you know, traded commodities for 25 years, says that the exchanges, which includes the LME and the COMEX, of course, are there to protect the large short holders, not protect the long holders. And I would suspect, although I don't know until we actually see it happen, that if things really get out of hand to the upside, they'll step in and to protect the shorts in the COMEX futures market as well.
Now, we've seen gold top to new highs, yet silver has yet to see its latest high of $30, let alone its all-time high of $50. Remember the Hunt brothers trying to corner the silver market back in the late 70s? Well, and yeah, you do, don't you?
I certainly do. As a matter of fact, I was in there buying physical silver at the time, so I'm more than familiar with what happened during that time period.
Well, they didn't really succeed, but I remember dentists at the time, because they used silver for fillings, really boosted their prices. But when the price of silver fell, they never lowered their prices. So a little lesson there, I guess. In the past, has silver lagged behind and then played catch up to gold? Will it catch up to gold?
Well, you know, silver should be, you know, some three-digit number right now. And right now, like you just pointed out, it can't even break through $30. Its old high from, I think it was February of last year. And that's mainly because the commercial traders continue to short the metal. And, you know, one of these days it will break free, but it certainly wasn't this week. And but there's no question if the commercial traders weren't sitting on the price right now, it would be many multiples of the price that you see today. But one of these days it will have a big catch-up. As to what day that's going to be, I have no idea, but it's long overdue.
What's the latest on the commitment of traders reports?
Well, the latest COT report is for positions held at the close of COMEX trading on Tuesday, and of course, I think that was the day we set our absolute high, or it came very shortly after that. So, not surprisingly, the commitment of traders report showed big increases in the commercial net short positions in both gold and silver. And when I was talking to Ted on the phone a little while ago, he said that this is the first time in almost a year that the big four shorts in silver have increased their short position by a meaningful amount. All the commercial traders went short, were sellers against all the non-commercial traders who were buyers. And it was their selling that capped the price at what it was, not only in silver but also in gold as well, because if they hadn't stepped in, prices would be much higher than they are right now.
How are the junior, mid-cap, and senior gold and silver stocks doing during this run-up in commodity prices?
Well, as everybody who has a stock account knows, they've done very well for themselves, and everybody's very, very happy with what they're seeing so far, and they're certainly expecting more to come. I'm expecting more to come too, so they're doing very well for themselves, and once we get above this 2,000 price mark and we get some more positive price activity, the rush will be on into the precious metal stocks even more than they are today.
Now, is it true the junior miners tend to lag behind in investment behind the senior and mid caps?
Oh, that's certainly true. It was true in the last run-up, and it certainly will be this time as well. However, this time, we've got other drivers. We've got runaway inflation, which isn't going to stop. We've got this little military confrontation going on in the Ukraine with Russia. Things are totally different now than they were back then. We have shortages, physical shortages in just about everything, including silver and gold at the retail and wholesale level. So once this gold and silver rush gets some real legs behind it, I don't think anything's going to lag. Anything that's got the word gold in it or silver in it is going to the moon. So I think this rally we're going to see that's unfolding now is going to be somewhat different than the last one. Everything's going to go at once here, because the rush from paper assets, whether it be bonds or stocks or whatever, into hard assets is going to be really on in earnest as inflation runs away to the upside.
John Rubino from DollarCollapse.com told us that there's already a premium for silver. If I went and bought a silver coin that's, say, worth $25 face value, I'm going to have to pay a $9 American bonus on top of that, a premium on top of that. Why is that?
Oh, heavens. The premiums at all the retail bullion dealers across North America and anywhere in the world today are absolutely extreme, and there's two reasons for that. First of all, there's always a premium anyway, because the spot price doesn't dictate what it actually costs to produce the coin. But right now, there's so little physical out there, it's so hard to come by that the dealers are forced to raise their prices or they're going to get cleaned out. This is a sign of screaming physical tightness in the retail market. And this has been going on since, I think last January, February, when the Wall Street silver crowd showed up in the silver market. And it's only gotten worse in the last month or so. And I don't see that changing anytime soon. We're going to be in a physical tight market for as far as the eye can see, and I'm talking about years down the road. So these premiums are high, and they're going to stay high, unfortunately.
Could we see a really big boost in the price of precious metals if everybody called up their broker and said, I would like my gold delivered on my doorstep tomorrow?
Well, that's certainly possible. That would have to happen in the wholesale market to really make a big difference. Right now, retail demand, is only what the mints, whether they be private or sovereign mints, can produce. So that's all that retail demand can be. But if the people who are long gold in the paper market decide they want to take delivery, and there just isn't enough gold or silver to be delivered, then we're going to have a problem. And that problem showed up in the last week or so in the COMEX futures market, because J.P. Morgan all of a sudden showed up as an issuer in its own account in both gold and silver, because if they hadn't, we would have had a default in the COMEX gold and silver markets within the last 7 or 8 days. That's how tight the physical market is, not only in the retail market, which you just discussed, but in the wholesale market too. And when J.P. Morgan shows up to issue contracts for delivery out of their own account, that the market is basically bone dry as far as physical metal is concerned.
Is that a big concern to you, that there isn't a lot of physical product out there for real?
Well, it should be concern to everybody out there. I know that, for us who, we buy our coins by the, 10, 20, 100 ounces or whatever it is, there's just no product out there, and the demand is only, the supply is only as big as what the mints can produce, but it's on the wholesale market, where sovereign nations and large corporations and hedge funds and stuff take a look at what happened to Russia, what they had their foreign accounts seized by the BIS, and they're starting to look at their own paper market holdings and say, gee whiz, maybe we should buy some, physical gold, a couple of 100 tons of it, because, we can find ourselves in the same situation as Russia found themselves in, or Venezuela, who had their gold seized. And I think the rush to physical gold by the large players out there, with sovereign nations, hedge funds, large corporations, we're going to see that kick into high gear. And when that happens, well, there's just no limit on how high the price is going to go or how big demand is going to get.
Over about the last 8 years now, Russia and China have been stocking up on all the gold they can lay their hands on. Canada and the UK sold off all of their gold, and we really don't know if the US has any gold in Fort Knox. So who's been doing the right move with gold over the last 8 years?
Well, yeah. I've been doing this now for almost 25 years, and, like you correctly pointed out, Brian Mulroney and Jean Chrétien, our prime ministers at the time, sold off all of Canada's gold, and Brown, I can't remember what the prime minister's name in England was at the time, he sold off all of England's gold in order to cover the short positions of the bullion banks when they got caught in the short squeeze involving the Washington Accord. And as you correctly pointed out, there hasn't been an audit of the gold in Fort Knox since 1953. So you have no idea, A, whether the physical gold is there, or B, whether how much paper is written against it and how much they actually have physical title to. And as you also pointed out, and as many other people who've studied the situation closely, figure that China has over 20,000 tons of gold, and Russia has been accumulating gold since back in, I think it was 2008 or something like that, 2005, and they've got about 3,200 tons of it right now. So, Europe's got a bunch of gold, and Russia and China have been buying gold, and China's been buying the stuff hand over fist for the last 20 years, and as they say at some point, the golden rule, he who has the gold makes the rules, and I think we're going to find that out real soon one of these days, because, China and Russia are pretty close together now, and if they decided that they wanted to do something with the price of gold, they could do it in a heartbeat. So, they're the smart ones, and the West is going to end up on the short end of the stick on this one sooner or later.
Now, I heard from a government official their premise for Canada getting rid of all of its physical gold as a nation, we have a lot of gold in the ground, and the government could just demand that gold from all the producers. How would that work out?
Well, I suppose it could be mined. There's no question about it. Canada produces, I don't know what, it's a couple hundred tons of gold a year. And, the government could say, okay, fine, you're not selling the gold to whoever, and we're going to put it into our own accounts. But by the time they get around to decide they're going to do that, the price of gold is going to be already astronomically high. So instead of paying, if they $500 or $300 or whatever it was way back when, they're going to be paying $3,000, $4,000, $5,000, $6,000 an ounce for it with currency that's not worth very much. So yes, they could do that, I suppose. But if you don't have the gold in your vaults, it takes years and years and years to produce any kind of decent volume in gold. And if you want to get back to where we were, which was before Mulroney sold it, I think we had about 660 tons in Canada. Or I think it was 660. And to get 660 tons of gold back into our reserves here in Canada, that's well over 3 years of Canadian gold production, and heaven knows only what price the government of Canada or the Bank of Canada would be paying for it as it comes out of the ground. The whole thing is absolutely absurd.
Back in the 1930s, during the Great Depression, President Roosevelt seized personal holdings of gold from American citizens. Any fears the same thing could happen again here in Canada and the U.S.?
Well, it never happened in Canada for a start. Okay. In the U.S. back in 1933, they were on a gold standard at the time. And things were a lot different because the paper currency was backed by gold, as every bill had on it, "Will pay the bearer on demand." So for the government to go out and try to seize everybody's gold holdings now, which, they haven't been on the gold standard for a long time, I wish them lots of luck with that. In Canada, you never know. I mean, we've got what happened with Trudeau and the truckers. And, that was scary enough, so I guess you couldn't put anything past the government. But I can tell you after this trucking thing, and nobody trusts Trudeau anymore and what the governments can and can't do. So I guess you can't write it off, but, write it off as never going to happen. But it would be a hue and cry, and I can tell you right now the gold price would be infinitely higher than it is now if they ever tried that.
Overall, are you bullish on gold and silver stocks this spring and summer?
Well, that's hard to say no to that. That's a real nice softball question, Jim. Of course, as the price goes higher and people, inflation is now runaway. There's just no stopping it. It's going to get far worse before it gets better. All commodity prices are going to rise. Of course, the king and queen are gold and silver. And once it starts to fly, then you're going to see the precious metal miners do very well for themselves. They're doing well now, and they're going to do phenomenally better once inflation really starts to take hold, and they allow precious metals prices to rise. It's going to be the go-to place to be is precious metal stocks.
Is there a big difference between physical and paper gold and silver?
Yes, there's no question about it. You do not want to own paper gold of any kind, or silver of any kind. I have a large stash of physical silver and some gold, and I do own some paper silver through Sprott, but I feel very comfortable with that, knowing that they have the gold. But as far as COMEX futures contracts or options or anything like that, you don't want to be anywhere near that. And everybody, and I mean everybody, should have some physical silver and physical gold in their possession, not of the paper variety at all.
Now, I believe these are connected. How are the HUI and XAU indexes looking, and how is the gold-silver ratio looking?
Well, the stocks are doing very well, as I just said, so obviously it's going to show up in the HUI and the XAU. The gold-silver ratio right now is around 79-1, which is absolutely ludicrous, because as Keith Neumeyer said, first the CEO of First Majestic Silver correctly pointed out, there's 7 ounces of silver that come out of the ground for every ounce of gold, so, the natural ratio is 7-1, and we're at 79-1 right now, so that's 11 or 12 times. So you take 11 times the current price of silver, 11 times 26, you can do the math. He's correct in saying that silver should be a 3-digit number right now, and someday it will be a 3-digit number. And that ratio will drop from 79-1 down to, let's just be generous and say it's going to go down to 15-1, which is its historic ratio. For a gold-silver ratio, you're looking at a silver price well in excess of $100, and that's where it's going to end up one of these days. And that's why I'm still all in on the stocks and the metal, because that's where it's going to be one of these days once this price management scheme that we're living under right now comes to an end.
Ed, can you tell us a little bit about Ed Steer's Gold and Silver Digest?
Yeah, okay, sure. It's you can just Google my name, Ed Steer Gold and Silver, and my website will pop up, and I have a sample column there under one of the tabs, and you can read what I have to say, and that's what my column looks like pretty much every day, except for the COT report and the bank participation report, which only come out weekly or monthly. And it's all about precious metals, the internal goings-on inside the gold and silver market. And if what you see interests you, you can sign up, and the freight is $100 US per year, which in Canadian fiat currency is about $127 right now.
Ed, thank you so much for being on This Week in Money.
Entirely my pleasure, Jim.
My guest has been Ed Steer, founder of Ed Steer's Gold and Silver Digest, online at edsteergoldsilver.com. He's also director of GATA, the Gold Antitrust Action Committee. He was speaking to us from Merritt, British Columbia. Coming up, Wolf Richter, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, we're seeing a lot of volatility in a number of markets. What's going on?
Yeah, it's pretty crazy, and we're seeing massive volatility in the stock markets globally, and we're seeing it in a crazy way in the commodities markets. We see quite a bit of volatility in the treasury bond markets and in some other places. So, I mean, just like in stocks in Europe, so yesterday, so that's Wednesday, in the German and French indices spiked by 8%, or nearly 8%, after having plunged, in the trading sessions before, and they were both well into a bear market, and so they had this gigantic relief rally of an 8% spike in stocks in just one day in these indices, and these are the indices of the big stocks. These are not tech stocks, low stocks. These are indices that capture the biggest companies, and then today they gave up a big part of that spike, and they plunged, and gave up 2.5-3%, and so about a third of more than a third of the gain yesterday, and we've seen this on a smaller scale in the U.S. markets with stocks jumping a lot yesterday and today, right now, they're down. We've seen in the U.S. markets that a whole category of stocks has gotten completely crushed. And I'm talking about the younger companies that had their IPOs recently or that went public via so-called SPACs. And I'm talking about some other companies that have become these meme stocks. And some of their shares, a lot of these companies are down 70, 80%, 90%, over 90%, a bunch of them. And they're smaller, so they're not in the S&P 500 index, so you don't really see the impact. They're on the NASDAQ, and that's why the NASDAQ has gotten beaten up. But these are huge declines in a very large number of smaller stocks. And people that have specialized in trading those, because there was a huge amount of money involved at first. We saw it skyrocketing on a daily basis, these stocks, and people that have, especially younger investors that have focused on these stocks, they have gotten crushed along with them. And so you see, and dip buying hasn't worked. Dip buying normally works in a bull market. But in a market where these categories of stocks just get killed, it doesn't work. You have a little dip, or maybe you have a 20% dip, and you got a 40% plunge afterwards. And if you don't get out in time, and it's very difficult because that 20% jump might only last a day, and you have to be very quick. You have to catch it at the bottom and then get out at the top in hours often. And if you can't do that, you're getting crushed. So this has been going on beneath the surface. Huge volatility with this entire category of stocks getting crushed. It started in February a year ago, with the first ones falling apart, and then stock by stock they did that. And in November is when the NASDAQ started heading south. It was still held up by the bigger stocks, by Apple and Microsoft and Amazon and those. And, they have done very well, and even though they've started to decline now too. But until then, they've done well, and they've hidden this fiasco that was going on beneath the surface. And now we can see in the stock market how it is broadening out, and we've had major stocks get sold off heavily. All major indices are down. And people are trying to buy the dip, but and then the recoveries, the bounces don't last very long, and so there's panic selling going on when they think it's going to turn around. So the dip buyers are trying to get out all at the same time, and so we're riding this down now from lower lows and lower highs, and as we go down, each time we have a low, it's a lower low, and each time we have a high, it's a lower high, and and so it makes dip buying a lot more aggressive, and it makes panic selling a lot more aggressive when the sell-off starts again, and it's a typical bear market scenario. That's what you get in a bear market. You get these incredibly vicious rallies. They come out of nowhere. You kind of can see them coming, but they just suddenly, you have these incredible spikes, and then the next day or two, you have these big sell-offs afterwards. And this kind of volatility is typical bear market volatility that we're now seeing, and there's no signs that it's going to abate anytime soon. What's going on in the commodities market is just totally crazy, especially in energy. We've had oil prices spike in just an incredible manner, and that has to do with the Russian invasion of the Ukraine and the sanctions. They're not really targeting oil, but they're targeting financial transactions, and shipping in a sense, and that's impacting the selling of physical oil. And now in the United States, of course, we've banned Russian oil, imports of Russian oil, and I think Canada has done the same thing. There's very little Russian oil we actually import. It's a very small amount of crude oil and a little bit more of unfinished oils. And so it's not going to be of any major detriment to the U.S. Economy overall, even though some refiners that have relied on those imports from Russia are going to have to find replacements that they can work with. And so we've got these energy price spikes now going through the economy, and every day the prices on our gas stations change. It's in California, we're now over $6 a gallon, and which is sort of the sound barrier of $6, and they tried to not get over it, and now they jumped over it, and it's over $6 a gallon, and $5 didn't slow anybody down, but $6 is starting to really get people's attention, and that's based on the spike in crude oil, and we've had natural gas go haywire on us. There's all kinds of other commodities. Wheat is spiking. Lumber spiked a year ago, and then prices collapsed again, and now it's spiking again, and it's just these incredible price spikes. We're talking about hundreds of percent. There's several 100% of increases in some of these markets. Like lumber, and oil is up like 40% in a relatively short period of time. These are huge increases. And then we have plunges. Like yesterday, we had a flash crash in WTI, our West Texas Intermediate benchmark grade, and it went from $126 a barrel to $103 a barrel in absolutely no time after the UAE indicated that the OPEC should be thinking about increasing its output. So, there's just white knuckle volatility, and with commodities going higher and stocks and bonds going lower. And that's kind of the trend that we're on.
So what's going on in the nickel market?
Well, nickel is in that commodity field that has been incredibly volatile, but it went through a special thing. It went through a short squeeze of the likes we haven't seen before. So this is futures trading on the London Metals Exchange, and we now know there's a Chinese tycoon who owns the largest nickel producer in the world, and he shorted nickel, large amounts of nickel futures, in part to hedge his production, and in part because he thought nickel will go down in price. And nickel has risen in 2021, so he so late in 2021 his bet, and that's very speculative bet. His bet was that nickel would decline from those levels in late 2021, and then we get the Russian invasion of Ukraine, and we get all the sanctions, and Russia is a big producer of nickel, and so nickel, the price of nickel went up, and this chap was caught with his huge short position as the market just went away from him, and so on Monday this week, the price jumped to $50,000 per metric ton. It's doubling in a day over the weekend, really. And on Tuesday, it doubled again. It jumped to 100,000 and per metric ton. And then the London Metal Exchange halted trading in nickel. And so. Now it turns out the guy was sitting on about $8 billion in accumulated losses. There were margin calls out. He appears to be working with lenders, including J.P. Morgan and China Construction Bank, and to get more loans. And so right now you cannot trade nickel on the London Metals Exchange. They're trying to figure out what to do with it. They're canceling some of these trades. There are counterparties that made a huge amount of money on those trades. They don't want those trades to be canceled. So it's a huge mess. And right now, there's still no trading going on the LME. And, so the guy's looking at $8 billion in losses, and he thinks that nickel will go back down. And that's probably true, so he doesn't want to close out his short positions at an $8 billion loss at the current price. Because, it can't stay at $100,000 per ton. And so, he's trying to get his bankers to lend him money, and the bankers, so the brokers, there's like 10 brokers involved in China, they got their margin calls from LME on his nickel, and so they're having to deal with this. It's a huge mess. And, this is just a speculative, naked short, that he's now trying to deal with, and the market just essentially got locked up, and they're trying to now bail him out somehow. And at some point the market will open up again, and probably nickel will trade at much lower prices than. But this is the kind of behavior we've seen. It's just gigantic risk taking, huge amounts of money involved in commodities in both directions. Lenders doing loosey-goosey deals, financing these bets, and we've got things blowing up now in nickel this week, and next week it's something else, and so this is sort of chaotic right now, and we're looking at markets that really have gone haywire.
Wolf, what's the latest on inflation?
We just got February CPI numbers today, so today's Thursday, and it was a horror show, and it's been worse than expected just about every month. And today CPI came in at 7.9%, so that's the worst since late 1981, and core CPI. So that's without the spike in food and energy prices, was at 6.4%. We got durable goods CPI that's at over 18%, and that's the highest in the history of the data going back to the 1950s. We've got non-durable goods CPI at over 10%, so that's the food and energy components and the household supplies. Services CPI, which had been kind of tame and has held down overall inflation, that has started to spike over the last few months, and today hit 4.8%, and that's going straight up. And that's a problem, because that's a big part of our consumer price index. So, and it has held down the CPI, and it's now releasing its hold, and it's still holding it down, but it's holding it down less. So we have this overall CPI of 7.9% inflation rate, and our interest rate is the Federal Reserve's policy rate is still near 0%. And this is just incredibly reckless what the Fed is doing that in face of this huge inflation. And it's, I've been thundering about it for over a year, and for this entire year, the Fed said that no, it's essentially it's going to go away on its own. It just keeps getting worse and worse and worse, and so now finally the Fed is acknowledging it. But they're going to do one mini rate hike on March 16th, and they're finally ending QE. But by being still near 0% with interest rates when inflation is nearly 8%. They're throwing gasoline on this fire, and they need to bring up their short-term rates to near the level of inflation to start cracking down on this inflation, and that's not happening. It won't happen anytime soon. Now they'll raise rates, they'll raise rates, pretty fast probably, but it just won't reach 8% or 6% anytime soon. It won't go anywhere near there. So this inflation is now getting baked into the economy. Everybody sees that. Businesses are passing on price increases that they're getting, and consumers are paying them. Consumers are griping. They're in a real sour mood, but they're still spending, and businesses are having to pay higher wages in order to retain and hire employees. And so we get this wage price spiral going, and that's now established as of sometime last year, and so there's nothing really that's holding back this inflation. So we've got the Fed still fueling inflation. We've got the wage price spiral in place. We've got chaos in the commodities market. So we've got chip shortages. We've got services inflation surging now. So I don't see that there's any decline in inflation coming our way. I mean, the monthly numbers may go up and then they'll go down a little bit, but the trend, I think, is higher, and I think there's a good chance we're going to see 10% inflation in the next few months, especially since this big spike in commodities prices that we saw in the last few weeks, that hasn't made its way into the inflation data yet. Yeah, some of it will show up in terms of gasoline prices in March, and that would be a shocker, and some of it will show up later as it works itself through the economy, such as the transportation sector. They're having to pass on those higher goods, and those price increases of transportation will get passed on to the consumer, but that takes time. So we'll see those commodity price increases enter the inflation data over the next few months, and push prices up further. Housing inflation is red hot in terms of rents and house prices. Housing inflation in our CPI is roughly 1/3 of the overall inflation. It's based on two measures of rents, and those measures have been artificially low, but they're now coming up, and they've started to surge. And that'll go on for that. They're catching up. It's a lagging thing. They're about a year behind. So they're going to keep rising regardless of what happens in the housing market. Those numbers are going to keep going up. And so I think 10% CPI is now my realistic estimate for sometime mid-year.
What's happening in the new and used vehicle markets?
Well, the good news is in the used vehicle market that there's plenty of supply. There's no shortage of used vehicles, and the inventory data that we're getting now indicates that in terms of supply, so that's the number of vehicles in inventory in relationship to the number of vehicles sold. That's above average. The total number of vehicles in inventory are below average, but sales have come down because prices have jumped. Prices are up something like 40% according to our CPI year over year. 40%. It means you're paying for a 2-year-old used car roughly what you might pay for the equivalent new vehicle. And so people are starting to be hesitant. and to buy at these prices. So used vehicle volume has started to tick down. Auction prices have started to dip a little bit. We're seeing some resistance among consumers, and that's starting to work itself into the market. I don't think prices will plunge like lumber prices plunge. I think they will come down a little bit, and then in that point, consumers will perceive this to be a deal, and they start buying again. And even though prices came down, say 10% or 20%, they're still up by 20% from where they were a year ago, and so that won't go back to where they were. They'll go down some, and then somewhere along the line, demand will pick up at those prices, at those lower prices, and that'll be the new low, and then they'll go from there. In new vehicles, there are real shortages, and they're getting better, but there's still chip shortages. We have still issues with certain types of chips. There are now more issues because of the invasion of the Ukraine, and there's issues with chips in Asia, and this is bedeviling the industry now. It's supposed to have been resolved a long time ago, and now it's getting better, but it's going to likely drag into 2023. New vehicle sales, they're selling essentially everything they're making. When it comes off the convoy, there's not a lot of inventory on the lots anymore. I read a number that 80% of the new vehicles sold were priced at above sticker, which is, I'm a car guy, and that to sell something above sticker used to be just an absolute rarity. Even to get sticker was rare. You had to discount quite a bit and make deals to get somebody to buy your vehicle. So now it's like, how much more of a sticker do you want to pay? And the automakers are looking at this askance. Ford is starting to tell it, from what I hear, Ford is starting to tell its dealers that they can't do that, or they lose the allocation. They can't slap addendum stickers on their MSRPs, and I don't know if that's going to wash out or not. But on our CPI data today, it showed that new vehicle prices are up 13% year over year, which is the highest inflation number for new vehicles ever in the data. That means that incentives, and so sticker prices haven't changed, but people are buying at above sticker now, and the incentives and discounts have gone away. So, I don't know what the demand is at these prices. There's enough demand right now to essentially pick up all the vehicles when they come in, but this is a relatively small number of vehicles that are being built right now. So we don't know what demand will look like when supply starts opening up at these prices. And it could very well be that at these prices, when supply is plentiful, that there isn't enough demand for these prices to stick around, and that prices will have to come down for as soon as inventories are starting to build. And this is something that we're still not seeing. We're still not seeing an increase in new vehicle inventories. They're desperately low. There's just a slight uptick because sales went down a little bit, and it's just minuscule. The new vehicle inventories on the lot are just horribly low, and the industry is really short of vehicles. Of course, they're charging these extremely high prices. The manufacturers are cutting their incentives, and the dealers are charging these high prices. So they're making a huge amount of money per vehicle sold, but they're not selling a lot of vehicles. So the profitability is incredibly high right now. You call this price gouging or whatever, but that's the situation we've got. And there's, an element of price gouging every time we have a big burst of inflation. That's just how it goes. And this is what's dogging the market right now. It's just there's a real supply shortage, and it's unrelated to anything that we can solve in the United States today. They're building chip factories now. They're starting the process. They're expanding capacity, but these are long-term projects. It takes years to get that new plant to actually start making chips, and so there is no short-term solution to this. from our side, most of these semiconductors are made some of them are made in the United States, but many of them are made in Asia, and so there's not a whole lot we can do at this point. It would be helpful to slow down demand a little bit, and so that everybody can catch up, but that's not happening right now.
Is there a higher demand for electric vehicles with gas at $6 a gallon in California and at least $8 per U.S. gallon in Vancouver?
Yeah, well, if they could make more EVs, that would sell more. There's a long wait list for all the EVs out there, and there's a lot of new models on the market, but they can't make enough of them. The legacy automakers have jumped into EVs now on a massive scale, but they haven't set up their supply chains yet for large scale production numbers, and so they're not set up to produce 500,000 pickup trucks a month, and it's just not happening, and so the demand is there for EVs. There's a lot of demand, but there's just hardly any supply. Tesla is still the largest maker of EVs in the United States. In China, there's a whole slew of EV makers, and in Europe, legacy automakers. Excuse the siren out there, fire truck going by. The automakers in Europe, they are starting to make fairly large numbers of EVs, but they're too handicapped by these chip shortages. So, I think these price spikes in gasoline are an incentive for people to buy EVs. And then, of course, your electricity at home is going up, too. It's not like there's no inflation in your electricity at home, so you're going to be paying more. But it's not comparable to the price increases that we see on gasoline. And EVs are inherently efficient the way they operate with their regenerative braking system. And so when gasoline gets to be very expensive, there are major cost advantages to an EV, and I think if we had production capacity to fill all the demand there is, we would see the numbers spike a whole bunch, but they can't make enough of them, so that's where we are right now on this.
Could interest rates move higher and faster than expected?
Yeah, so it depends on who you ask what they expect. The financial markets are now starting to grapple with this idea that interest rates will actually rise. And for a long time, they've said interest rates will never rise. The Fed is trapped. That's quote unquote. That's what they said. The Fed is trapped. It cannot raise interest rates. There is too much debt out there. The Fed will have to keep doing QE. So the markets have been delusional about this. And so now the Fed has pretty strongly communicated that it will raise interest rates and it will end QE. And in fact, QE has ended right now; it's ending this week, and that it will actually reduce its balance sheet. So QT, quantitative tightening, and the markets. Parts of the markets are starting to price in 7 rate hikes this year, but in terms of the stock market, they're in complete denial. They're in denial about QT. They're in denial about interest rate hikes. And some of the sell-off recently shows that maybe they're less certain about the denial, that they're now doubts starting to creep up. But when the Fed is talking about removing several $1 trillion of liquidity over the next couple of years, a few years, and bringing interest rates, short-term interest rates up to 2 or 3%, and long-term interest rates would rise further because of the Fed is now shedding the bonds on its balance sheet. You would look at longer-term rates of maybe 5% in the Treasury market, and that is something that's not at all priced in, and it's not priced in anything, and the long-term interest rates have a much bigger impact on stocks and on the economy than anything else because it determines the funding cost of companies. There'll be a lot of junk-rated companies with with problems. They're not making enough money to pay the interest, and they're going to have trouble refinancing their debts, and their interest rates will go up if they can refinance them. And so you'll have an increase in bankruptcies. And this is what you get when financial conditions tighten, and that's what the Fed wants to do. It has to do to crack down on inflation. That's the only thing that will actually take the fuel away from inflation is to tighten financial conditions, and so these companies will then have to deal with that, and I think the stock market will eventually come to grips with that, but it will be bumpy and rough to get there, and unless a miracle happens, inflation will just keep going up until short-term interest rates are much closer to the rate of inflation, and until long-term interest rates are above inflation. So long-term interest rates today, the 10-year Treasury is at 2%. Inflation is at nearly 8%. So the 10-year Treasury would have to be above 8%. For it to be something that would push down inflation. And of course, when the Fed starts raising interest rates, the inflation starts to slow down its increase. Eventually, there's a lag. Eventually that will happen. So it may not have to raise interest rates that much, and as it did in the past, in the 1980s, Volcker had to raise short-term interest rates to nearly 20%, and that the Fed doesn't need to do that. It has its balance sheet and there's other measures to get this inflation under control, and it can. And I'm confident that if the Fed really wants to get this inflation under control, it can. There's no doubt in my mind, and it can do so very quickly. It has its huge balance sheet. It can sell the assets outright. It can cause markets to crash, and that will take the inflationary wind away instantly. It'll stop. Businesses and people will get hesitant to pay these higher prices, and that's the end of inflation. And but the Fed wants to engineer a soft landing, so the markets are not buying into it. They're just kind of delusional about it.
What's happening in real estate? What do you see ahead?
Well, we've got just globally the biggest real estate bubble ever, and fed by this money printing, this global money printing bench, and by these 0% interest rates, and with mortgage rates being very low now, and so interest rates have gone up, long-term interest rates. In the United States, our benchmark mortgage is a 30-year fixed-rate mortgage, so those rates have now gone over 4%, and that's pretty high for the housing prices that we have, and so it's already a whole layer of buyers has been eliminated. And this is a slow-moving thing, but higher mortgage rates will slow down the housing market. That will make housing a lot more expensive, and then you have to ask yourself, who can even afford it, those prices? And then when nobody can afford to buy homes at these prices, and there's a seller, they have to lower the price to where they can find a buyer, and a buyer that can finance it at 5% or at 6% on a 30-year mortgage, and that takes years, but it's a process that I see coming. The higher mortgage rates means lower home prices, and it has worked the other way around. When mortgage rates plunged to historic lows, home prices spiked, and so now that process is over the next few years is going to get reversed.
Are high oil and gasoline prices warning that a recession is around the corner?
Yeah, I don't think so. Last time we had the spike in energy prices, the sudden spike in energy prices was in 2007, 2008. And of course we got the financial crisis, in 2008, but we got a recession not because of high oil prices, but because the housing market collapsed and the mortgage market collapsed, and 11 million, 10 million people lost their jobs, and that's what triggered the inflation. A healthy economy can deal with higher energy prices, especially in the United States, where the energy input is not that huge anymore. And yeah, there'll be adjustments and there'll be gripes and moaning and people will have to, businesses will have to adjust. But I don't think it will cause a recession. And you know, energy prices on an inflation-adjusted basis are still far below where they were in 2008. So it's really not reached that kind of level. And you know, for a recession to be triggered, the last recession, so we had two, and one of them was triggered by the financial crisis when the banking system was on the verge of collapse because the housing market had collapsed and because the mortgage market had collapsed. And then, so that was 2008, and so now we got another recession in March 2020 because of the lockdowns. And that was the shortest recession in history, you know, and it takes a big thing to cause a recession like that. I don't think that an increase in energy prices alone will do that. There will have to be a lot more to it than just that.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ed Steer, and Wolf Richter, and thank you for listening. If you have any questions for the show or our guests, we'll ask those questions for you if you send them to info@HowStreet.com. Now stand by for a company showcase update from Zarko Meseldzija of American Manganese. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the CTO of American Manganese. Welcome back to the show.
Thanks, Jim. Nice to be on the show.
Zarko, you're working on your demonstration plant. How are the operations going, and where is this taking place?
Yeah, well, it's taking place in the Greater Vancouver area here in Canada. I just want to let everybody know that I'm stepping in for Larry this week to provide an update and clear the air regarding our RecycLiCo demonstration plant project, because I know many of you have been patiently waiting for an update since our projected February timeline. We have made great progress, but really the elephant in the room is clearly our delay to provide an update. There's no point for excuses because we feel the pressure ourselves every day, and it motivates us to work twice as hard to keep moving forward. And really, there's nobody out there that's more eager than me to get things going. But with that said, we are working on the finishing touches of assembly, which we hope to have an update for next week. However, I would not interpret the delay as an indication of something negative towards our process. We're just dealing with the limitations in front of us each day as we prepare for the commissioning test. However, I still consider ourselves very lucky to receive the equipment that we have, given the grand scheme of supply chain issues, increasing prices, and the market conditions have plagued many industries with unbelievable delays. You see it in the EV industry all the time, and microchips and whatnot. But although I would recommend you follow us on social media because we do provide, we do have a little micro update, such as the one we shared of our initial test run of our shredder, which is used to reduce the size of the large cathode coated aluminum sheet that we received into a much smaller, more uniform shape before it's fed into our pre-leach stage. That pre-leach is where we remove the cathode active material from the aluminum foil. There, the aluminum foil is collected, but the cathode active material, which is made up of that lithium, nickel, manganese, and cobalt, is what's extracted with our leach process as the next stage. But we also don't want to be operating blind. So what we do have and what we have planned to do is collect data from each stage to validate the same high extraction efficiencies we've seen on our lab and pilot scale, and refine our chemistry as needed. on the social media, we also shared a picture of our clean water system, which is used to ensure we're using clean water to produce the high purity products, because we don't want any kind of contamination. The battery industry is not very forgiving on impurities, and a dirty product requires more cost and energy to clean. But what's also, most important is our closed loop approach on the water use to further reduce our environmental impact, which really brings me to an important topic, because I'm actually really looking forward to quantifying these environmental impacts once we complete our third-party life cycle assessment with Minviro. Over the past few weeks since we announced this work, they have dissected and accounted every stream of our process, which will also be benchmarked with the environmental impact of producing the same product from mined materials and conventional recycling processes. And I think these LCAs, or life cycle assessments, will be critical and very impactful data for financing and project development, which will raise the bar for many miners and recyclers. But with everything coming together, we think the RecycLiCo demonstration plant will have a big impact and a big statement in the industry, because when it comes to hydrometallurgical processing, I have not seen many facilities with comparable capacities presently that have adopted a similar advanced hydrometallurgical processing method to recycle and upcycle waste lithium-ion batteries. I've said it before, but the nuances in the word recycling don't clearly differentiate between the mechanical shredding of a battery versus the chemical processing. And we're seeing a lot of the shredding right now in the industry and what's quoted. Even now, the demonstration plant has been receiving lots of attention with a few in-person and virtual plant tours given to some third parties that are both industry and financial related. And the excitement is there, as it all comes together. And, let's not forget that through the doom and gloom of these current events and market conditions, I think, we are definitely in a growing and hot industry. I had a firm share their battery materials market update report with me, and really what stuck out to me is how well metals and mining, clean energy, and battery materials has outperformed the rest of the market. People who I highly respect are well researched see these shifts, and it's really a testament to our $20 million financing late last year that has also given us great runway as we progress our project. So in closing, we really think long term, and we have continuously fortified our technology for this growing industry with a lot of deep rooted work. And I hope to provide more updates in the near future. But yeah, I'll leave it there for this week, Jim.
Zarko, for people who are unfamiliar with American Manganese, what's the company all about, and where are you traded?
American Manganese is a critical metals company. Our focus is on our RecycLiCo process, which is the recycling and upcycling of lithium-ion battery waste to recover lithium, nickel, manganese, and cobalt. We are traded on the TSXV under the ticker symbol AMY, on the OTCQB under AMYZF, and on the Frankfurt Stock Exchange under 2AN.
If people wanted more information, where should they go?
They can go to our website, www.americanmanganeseinc.com. As I also mentioned, the social media, we have our Twitter, LinkedIn, Facebook, where we'll have those little micro updates as well.
Zarko, thank you so much for the update.
Thank you, Jim. Pleasure speaking with you.
I've been speaking with American Manganese Chief Technical Officer Zarko Meseldzija. I'm Jim Goddard. Our conversation took place on March 11.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.